Welcome to Hash Speaks Finance. Today we'll discuss how to start investing as a beginner. I know it can feel like you're kind of drowning in information out there, with all those ebooks and those courses. And let's be honest, some pretty sketchy advice just floating around. You might be thinking, where do I even begin? And that's totally fair. But here's the good news. You don't need a pile of cash to get started. You don't even need any money to get started. See, one of the biggest mistakes I see new investors make is jumping right into the market with real money. They hear those get-rich-quick stories and think, hey, I could do that too. And then, bam, they get hit with a dose of reality. Most new traders who start that way, they end up losing money. They get discouraged and they quit. And you know what? I don't blame them. It's tough out there. But what if I told you there's a way to short-circuit that whole emotional learning curve? A way to learn the ropes, make mistakes, and figure out your strategy without putting your hard-earned cash at risk. That's where the secret weapon comes in. Trading simulators. Think of it like a flight simulator for investors.
You're in the cockpit, you got all the controls. But you're not actually flying a plane yet. You're practicing. You're getting a feel for things. And most importantly, you're not going to crash and burn in the process. With a simulator, you get to trade with fake money. So you can experiment with different strategies, see what works, what doesn't, and learn how to manage your emotions, which let me tell you is a huge part of trading. Now, I know what you're thinking. Fake money. What's the point? Here's the thing. The key to using a simulator effectively is to treat that fake money like it's the real deal. Imagine your rent or your next vacation depends on those trades. You'll be amazed at how much more focused and disciplined you become. Now, where can you find a good trading simulator? There are tons out there. Some are paid, some are free. One platform I really like is Webull. It's super user-friendly. They've got a great interface, and they even give you some free stock shares when you sign up. Plus, their charting tools are fantastic. Okay, so you got your simulator set up. You're ready to start making trades. Now what? This is where another essential tool comes in, the trading journal. Don't overthink this.
It doesn't have to be anything fancy. Just grab a notebook or even a simple spreadsheet will do the trick. But here's the crucial part. Every time you make a trade, whether it's a win or a loss, write it down. And here's the kicker. Don't just log the trade itself, but also your emotional state at that moment. Were you feeling anxious, excited, maybe a little bit too confident? And here's where the real magic happens. After a cool down period like a day or two, go back and review those trades, especially the losing ones. Look for patterns. Did you break your rules? Did you chase a hot stock tip? Did you let your emotions cloud your judgment? By identifying these patterns, you start to see your own biases, and that's UUGE. And for the winning trades, break those down too. What worked? Was it your strategy, your patience, or maybe a little bit of luck? By analyzing both your wins and losses, you start to build a roadmap for consistent success. Trust me, I wish I had started a trading journal years ago. The mistakes I could have avoided, the money I could have saved. It's a game changer. Now, while you're in the simulator honing your skills, it's crucial to make a mindset shift. Don't focus on making quick profits right away.
I know it's tempting, but that's not the point of this stage. Your primary goal should be to master your strategy, to understand the market, and to become a more disciplined trader. It seems counterintuitive. I know, but trust me, when you focus on the process, the profits will follow. Think of it like learning to play basketball. At first, you're going to fumble the ball, you're going to miss shots, you're going to get frustrated. But if you keep practicing, if you focus on your footwork, your dribbling, your shooting form, eventually you'll start sinking those baskets like a pro. Trading is the same way. It takes time, it takes patience, and it takes a commitment to continuous learning. But the rewards can be incredible, both financially and personally, because when you master the art of trading, you gain a sense of control over your financial future. You're no longer at the mercy of the market. You're actively participating in it, making informed decisions and building wealth on your own terms. And that, my friend, is an incredibly empowering feeling. Now I know what you're thinking.
Okay, simulator journal, got it. But what about the actual mechanics of trading? Yeah, where do I learn about things like, picking stocks, setting stop losses, all that good stuff? Well, before you dive into all that, there's one more crucial step. Choosing an online brokerage. Think of a brokerage as your gateway to the market. They're the ones who execute your trades, hold your money, and provide you with all the tools and resources you need to invest. There are a ton of brokerages out there, each with their own pros and cons, their fee structures, their trading platforms, all that. So it's important to do your research and choose one that aligns with your needs and your trading style. Now, when you're choosing a brokerage, you'll likely come across different account types. The two most common being cash accounts and margin accounts. Cash accounts are pretty straightforward. You deposit money, and you can only trade with the cash you have available. Margin accounts, on the other hand, allow you to borrow money from the brokerage to amplify your buying power. Sounds tempting, right? Well, here's the catch. Margin trading can magnify your gains. but it can also magnify your losses. So if you're just starting out, I highly recommend sticking with a cash account until you gain more experience and confidence. All right, so you've got your simulator, you've got your journal, you've chosen a brokerage, you've even opened a cash account, you're all set to go. But hold on a second. Before you even think about placing your first trade, there's something you need to understand. The market is a complex beast. It's driven by a multitude of factors, news events, economic indicators, investor sentiment, you name it. And if you want to be successful, you need to have at least a basic understanding of how it all works. That's where learning about different trading strategies comes in. There are tons of different approaches out there, from fundamental analysis, which looks at a company's financial health, to technical analysis, which uses charts and patterns to predict future price movements, to quantitative analysis, which relies on mathematical models and algorithms to make trading decisions. It can feel overwhelming, I know. But don't worry, you don't need to become an expert in every single strategy overnight. Start with one that resonates with you, something that makes sense to your brain, something you can grasp and apply.
And then test it out in your simulator. See how it performs, tweak it, adjust it, make it your own. Remember, the simulator is your playground, your laboratory, your risk-free zone to experiment and refine your approach. And as you're testing out different strategies, keep that trading journal close at hand. Log every trade note down, your observations, your insights, your aha moments. This journal will become your treasure map, guiding you towards consistent profitability. Now let's talk about one specific strategy that you can try out in your simulator. Something simple yet powerful, the moving average crossover. Essentially, you're looking at two different moving averages. So let's say the 50-day moving average and the 200-day moving average. When the shorter-term 50-day moving average crosses above the longer-term 200-day moving average, that's considered a bullish signal indicating that the stock is gaining momentum and might be poised for an upward move. Conversely, when the 50-day moving average crosses below the 200-day moving average, that's a bearish signal suggesting potential weakness. I'm not saying this is the holy grail of trading strategies, not at all.
But it's a great starting point. A simple yet effective way to identify potential trading opportunities. And the beauty of it is you can easily test it out in your simulator, see how it performs with different stocks, different time frames, different market conditions. Remember, the goal here is not to blindly follow any one strategy, but to understand the underlying principles, to develop your own intuition, and to become a more confident and informed trader. And speaking of confidence, that brings us to another crucial aspect of trading psychology. This is all about understanding how your emotions can impact your trading decisions, both positively and negatively. Because let's face it, trading can be an emotional roller coaster. You've got fear, greed, hope, despair, all these emotions swirling around in your head, and if you're not careful, they can completely sabotage your trading plan. Think about it. You place a trade, it starts going against you. You see those red numbers flashing on your screen, and suddenly your heart starts racing. Your palms get sweaty. You can't think straight. That's fear kicking in, telling you to get out to cut your losses before things get any worse. But what if that fear is misplaced?
What if the market is just testing your resolve? And if you hold on a little longer, the trade will turn around in your favor. Tough call, right? On the flip side, you might have a trade that's doing really well. It's up big jump. You're feeling invincible, like you've cracked the code to the market. That's greed whispering in your ear, telling you to hold on to squeeze every last penny out of the trade. But what if that greed leads you to hold on for too long, and the market suddenly reverses, wiping out all your gains? Again, a tough call. That's why understanding trading psychology is so important. It's about learning to recognize those emotional triggers, to develop strategies to manage your emotions, and to make rational, disciplined decisions even when the market is testing your nerves. And that's where your trusty trading journal comes in handy once again. By logging your trades and noting down your emotional state at that moment, you start to see patterns. You start to understand how your emotions impact your trading decisions. Maybe you notice that you tend to make impulsive trades when you're feeling stressed or tired.
Or maybe you realize that you get overly confident after a string of winning trades, leading you to take on more risk than you should. Whatever those patterns are, by identifying them, you can start to develop coping mechanisms. Maybe you need to take a break from trading when you're feeling overwhelmed. Maybe you need to create a set of trading rules and stick to them no matter what. Or maybe you need to practice mindfulness or meditation to calm your mind and stay focused. The point is, trading psychology is just as important as any technical or fundamental analysis you might do. It's about mastering your own mind, about becoming a more disciplined and emotionally balanced trader. And the more you understand your own psychology, the more successful you'll be in the long run. So there you have it. We've covered a lot of ground today, from the importance of using a trading simulator and keeping a trading journal, to choosing an online brokerage and understanding the basics of trading strategies and trading psychology. I know it's a lot to take in, but remember, you don't need to master everything overnight. Take it one step at a time, focus on learning and improving each day. And most importantly, enjoy the journey.